Hello there, I'm Black Bright News, and if you're anything like me, when you saw that HMRC headline about their gunning for people who've got more than £3,500 worth of savings, you can kind of think, bloody hell, what's going on? So I decided to do a little research, dip into it, and I'm going to talk about it now. I've got all my notes together, and like I said, I like to be concise, so I kind of stick to a 10-minute deadline. So let me get on with it before I go over and it ends prematurely. So the headline, the HRC 3,500 savings is going to be taxed. So I noticed the headline today that HMRC has been sending out what has been described as demand letters to savers with as little as 3,500 in their account. And I suspect I wasn't alone in pausing at that number, because on the face of it, that sounds alarming. 3,500 is not a large sum. For many people, it's an emergency buffer, a bit of careful planning, or simply money that hasn't been spent yet. So the idea that this amount might somehow attract the attention of the tax authorities immediately raises questions and, understandably, concern. But once you look beyond the headline, what becomes clear is that this story is not really about the 3,500 at all. It's about interest, and that difference matters. The savings themselves are not being taxed. HMRC is not sending letters because people have a few thousand quid in the bank. What's being looked at is the interest that money earns, and is specifically whether that interest goes beyond what you're allowed to earn tax-free in a given year. That may sound like a small distinction, but it's actually a fundamental one. Savings are capital, interest is income, and HMRC has always taxed income, including savings interest, once it passes certain thresholds. What has changed recently is not the rule, but the environment in which that rule now operates. For a long time, more than a decade, savings interest was so low that most people barely noticed it. Rates hovered close to zero. Many savings earned only a few pounds a year, sometimes even less. During that period, the personal savings allowance existed in theory, but in practice, it didn't come into play for the vast majority of people. You simply just never get close to it. Now that has changed. Interest rates have risen sharply, and savings accounts are once again paying 4, 5, sometimes 6%. For the first time in years, money left on deposit can generate a meaningful return. And when interest becomes meaningful, it means visible to the tax system again. It becomes visible to the tax system again. HMRC receives information directly from banks and building societies about how much interest they've paid to each customer. When that interest goes above personal savings allowance, which depends on your income tax band, HMRC may need to collect tax on the excess. In some cases, that can be done through a tax code adjustment. In others, a letter is sent. Now, this is where the 3,500 figure enters the story, not as a rule or a trigger, but as an illustration. In today's interest rate environment, especially for higher rate taxpayers or for people holding fixed-term savings that pay interest in one lump sum, a relatively modest pot can generate enough interest in a single year to exceed the allowance. When that happens, tax may be due. At the current interest rate, you need about £70,000 in savings to generate the 3,500 of interest in a year. A 3,500 savings balance itself earns only a fraction of that, which is about £175. But conflating the two makes the situation sound far more dramatic than it is. But the headline compresses all of that into a single misleading idea, that HMRC is targeting people for having 3,500 in savings. That's not what's happening. The money itself is not the issue. The interest on the money is. And what makes this story resonate, though, is not just confusion about tax mechanics, it's the element of surprise. Many people simply aren't used to thinking about savings interest as taxable income anymore. For years it didn't matter, so when a letter arrives, particularly one described in dramatic terms, it can feel as though the rules have suddenly changed or that saving itself has somehow become a problem. There's also the language used around these letters. The phrase demand letter carries weight. It sounds urgent, even accusatory. In reality, what many people are receiving is a tax calculation or a simple assessment. Essentially, HMRC are saying, based on the information we have, this is what we think you owe. That doesn't mean it's final, it doesn't mean it can't be queried, and it certainly doesn't mean HMRC is accusing anyone of any wrongdoing. It's also worth saying that not every letter that looks official is genuine. Scams are common, and HMRC itself warns people to be cautious. A real HMRC letter won't ask for personal details by email or text, and the payments are made through official channels. If there's ever any doubt, it's always best to check using contact details from the government website rather than those printed on the letter itself. Stepping back, what this episode really highlights is how quickly financial understandings can slip out of date. The rules around savings interest haven't suddenly appeared. They've been there all along, but when interest rates were low, they faded into the background. Now that interest is back, the rules have resurfaced, and many people are encountering them for the first time. That's why the 3,500 headline feels so jarring. It suggests a world in which even modest savings is under scrutiny, when in fact the system is doing what it has always done, tax income above certain thresholds. The problem isn't the tax itself, it's the gap between what the people assume is happening and what is actually going on. And that gap matters because confidence in saving is fragile. People need to feel that putting money aside is sensible and worthwhile, not risky or opaque. Clear explanation helps. Sensational headlines don't. So if there's a takeaway here, it's a simple one. Your savings are not being taxed for existing. There is no new £3,500 limit. What matters is how much interest your savings earn over the course of a year and how that fits alongside your other income once you understand that. The story looks far less threatening and far more familiar. This monologue is based on publicly available information about UK savings, interest, taxation and HMRC procedures. It is intended for general commentary and broadcast discussion, not as individual financial or legal advice. Tax treatment depends on personal circumstances, and official HMRC guidance should be consulted where necessary. So I hope that's useful for anyone who saw that headline like I did and thought, bloody hell, 3,500, they're going to tax me on it. It's bloody ridiculous. No, you'd have to be earning £70,000 to accumulate 3,500 worth of interest so that the HMRC start approaching you and saying that you owe them interest on that 3,500. I don't know what the percentage is, but hey, you never get away with anything, do you? Every little penny is taxed. So that's it really. I hope you found it useful and helpful. I think I've got one more, but I'm dozing off. Honestly, I'm so tired. Had a long day at work, but I thought I'd keep you company for a little while. And I do hope you find my videos useful. You take care now. Bye-bye.